OpenAI just closed a $122 billion funding round. That is not a typo. It is the largest private technology raise in history, and it rewrites the competitive math for every company building or buying AI. In the next few minutes, I will break down exactly where that money is going, what it means for your business, and what you should do about it right now. Here is what happened. OpenAI announced a round that started at $110 billion in late February 2026 and closed at $122 billion by the end of March. The post-money valuation landed at $852 billion. To put that in perspective, that is larger than all but a handful of publicly traded companies on the planet, and OpenAI is still private. The anchor investors are Amazon at $50 billion, Nvidia at $30 billion, and SoftBank at $30 billion, with Microsoft, Andreessen Horowitz, T. Rowe Price, and others filling in the rest. In an unusual move, over $3 billion came from individual retail investors through bank channels, and RK Invest confirmed it will include OpenAI in several of its ETFs. That is the first time everyday investors get structured, broad market exposure to OpenAI's upside before an IPO. Now, a critical detail: a large portion of this money is not cash sitting in a bank account. It comes as infrastructure commitments. OpenAI committed to consuming at least 2 gigawatts of Amazon's Trainium chip capacity and expanded its existing AWS cloud deal by $100 billion over 8 years. On the Nvidia side, OpenAI locked in 3 gigawatts of dedicated inference capacity and 2 gigawatts of training on Nvidia's next-generation Vera Rubin systems. Think of it like this: OpenAI is not just raising money, it is pre-purchasing the electricity grid for the AI era. Compute is the oil, and OpenAI just secured the pipeline. So, why should you care? Let me give you 3 concrete scenarios. First, if you run enterprise software or build products on top of AI APIs, the pricing and availability landscape is about to shift. OpenAI is now generating $2 billion a month in revenue, enterprise accounts for over 40% of that, and the company is building what it calls a super app combining ChatGPT, internet browsing, a codex coding tool, and agentic capabilities. That means more integrated, more capable tools, coming to market faster, which raises the bar for any competing product you might be building or buying. Second, if you are on AWS, pay attention. OpenAI models will run natively on Amazon's Bedrock platform through a new stateful runtime environment. That means enterprise teams already deep in the AWS ecosystem will soon be able to access OpenAI's frontier models without leaving their existing cloud stack. If you have been weighing Azure versus AWS for your AI workloads, this changes the calculus. Third, if you are an investor or founder in the AI space, the competitive baseline just moved dramatically. OpenAI's nearest rival, Anthropic, has raised about $14 billion lifetime. OpenAI has now raised over $122 billion in a single round. That capital gap compounds across talent acquisition, chip procurement, data center buildout, and model training. Every other frontier lab and AI startup is now operating on a fundamentally different playing field. But let us talk about what can go wrong, because the risks here are real. The most obvious concern is circular financing. Amazon invests $50 billion into OpenAI. OpenAI then commits to spending over $100 billion on AWS. Nvidia invests $30 billion, and OpenAI commits to buying gigawatts of Nvidia compute. Critics on Wall Street have flagged this as a structure that can inflate both revenue and demand figures. The actual cash changing hands versus services rendered will matter enormously, and OpenAI has not disclosed the precise split. Second, $35 billion of Amazon's commitment is contingent on conditions that have not been fully disclosed. Reports suggest it may be tied to OpenAI achieving AGI or completing its IPO by the end of the year. That is a meaningful asterisk on the headline number. Third, OpenAI is still not profitable. It is targeting roughly $600 billion in total compute spend through 2030. Even with $2 billion a month in revenue, the burn rate is extraordinary. If revenue growth slows or competition from Google DeepMind, Meta, or open-source models intensifies, that spending could become a liability rather than a moat. And finally, concentration risk. When 3 megacorporations account for the vast majority of your funding and are also your primary infrastructure suppliers, governance questions multiply. OpenAI's non-profit foundation now holds a stake valued at over $180 billion, but the structural incentives are increasingly aligned with its corporate partners, not the original mission of broadly beneficial AI. Here is what you should do in the next 30 days. 1. Audit your AI vendor stack. If you are building on AWS, start evaluating the OpenAI models coming to Bedrock. If you are on Azure, confirm with Microsoft that your existing access and pricing terms remain intact. Microsoft and OpenAI issued a joint statement saying the Amazon deal does not change their arrangement, but you should get that in writing for your contracts. 2. Stress test your competitive position. If you are building AI-powered products, model what happens when OpenAI's super app launches with integrated browsing, coding, and agentic features bundled together. Identify where your differentiation survives and where it does not. 3. Watch the IPO timeline. OpenAI is widely expected to go public this year. If you are an investor, the ARK ETF inclusion gives you a new access point. If you are a competitor or partner, an IPO will force OpenAI to disclose financials for the first time, giving you real data on margins, churn, and unit economics. 4. Review your compute contracts. OpenAI's massive infrastructure lockups with AWS and NVIDIA could tighten supply for everyone else. If you have large-scale training or inference needs, secure your capacity commitments now rather than in 6 months. 5. Brief your leadership team on the circular financing dynamic. Understanding how these mega deals inflate headline numbers will help you make better decisions about partnerships, valuations, and vendor dependencies in the AI space. The bottom line is this: OpenAI just locked in more capital, more compute, and more distribution than any private technology company in history, and the real question is no longer whether AI infrastructure will be built at massive scale, but whether the returns will justify the investment. Subscribe to AI Blueprint so you are the first to know when that question gets answered.